let's jump into it. Kevin, let's talk about our new topic, financial planning in regards to tax strategy.
Yeah, I think that the big elephant in the room is that there was a tax cut passed during the Trump administration, commonly called the Trump tax cuts, and it expires soon. A year and a half or so, we really got to get some planning done because at the end of 2025, everybody's tax rate's going up. There's a lot happening in there. So, just as a reminder, some major changes took place. We got a higher standard deduction. Tax rates for everybody went down. The estate tax went down. Mortgage interest changed. The SALT caps changed. Corporate taxes actually got cut lower, and those are permanent for some reason, while individuals was temporary. So, I think it's very important to talk about tax strategies to reduce that, but even more so over the next couple of years in anticipation of everybody's rates going higher. So just one thing, I would say the top rate goes from 37% to 39.6%. Everybody else is going to go up a few percent as well. So I think it's essential to find ways to defer or reduce your tax burden going forward.
Okay, so let's break it down to a couple big ones that's going to affect everyday consumer, listener, etc. So we got top tax rates going up. We knew that was coming. What else do you see out there that's going to catch people off guard when this sunsets at the end of 2025?
Yeah, the big thing is the standard deduction. So if you're not itemizing, and it doesn't make sense for the majority of people to itemize, it's the small percentage, and probably many of our clients do itemize. But right now for 2023, the standard deduction for a couple is $27,700. Once these expire, that deduction goes down to $12,700. So more than cut in half. That's a pretty big drop to have suddenly $15,000 more included as taxable income. And if you're getting taxed at 20 or 30%, that's a few $1,000s you're going to be paying. The second thing would be the cap that was placed on the state and local tax deductions, so commonly known as SALT, was capped at 10,000. Once the Trump tax cuts go away, that cap no longer applies, but there's phase outs for people who have like a few $100,000. That deduction goes away as well. So there's a lot of things you can do. So the first thing I would say is in 2025, you can use the standard deduction and you could wait to pay your property taxes. So if you live in Texas, average 2.7% for your property tax. Let's say you're paying $10,000 now. Well, you could stack those tax payments all in the following year. So you typically get your bill sometime in the fall, maybe October, November, and it's due by the end of January of the following year. You could pay it in January of 2026 for the first time and pay the second year, so for 2027, at the end of 2026. And the benefit of that is if that SALT deduction goes away, you're going to get a much higher deduction, and it'll make a lot more sense to itemize since the standard deduction is going to go from almost 30,000 down to 13,000.
So what else can we be doing? So that's at the end of 2025. What do we start doing now to prepare for taxes?
Well, it depends. So if you're a very wealthy family, state taxes are going to jump. So you need to start getting that exemption now. So if the exemption is going to go down a significant amount after 2025, you need to go ahead and do your tax planning now, complete those gifts, get that out of your estate. That way you're not taxed on otherwise. If you're somebody that has a mortgage, good news. You might want to cash out refinance after 2025 because instead of being capped at 750 of principal on qualified debt, it goes back to $1 million, which is where it used to be before that. And if you had home equity interest, that was reduced now. It'll go back to get the first 100,000 of that debt is actually deductible for the interest payment. So, there's a chance for you to suddenly go, oh, wow, my whole picture is going to change of what I should be doing to minimize the amount of taxes and maximize my deductions.
I think the one time sensitive one that you mentioned are estate taxes. So as it sits right now, an individual their lifetime exemption amount is 10 million. Well, actually, it's over 10 million because it goes up with inflation. Let's call it 12 million. If you're married filing jointly, it's 24 million. Meaning, you have $100 million estate and you pass away today, 24 million is exempt from estate taxes. The other
A lot of money.
76 million is going to the IRS at a rate of 40% over that lifetime exemption amount. When this tax rule sunsets at the end of 2025, it's going to go back down to 5 million per individual. So married filing jointly, it goes back down to 10 million. Now, many of you listening, that might not be an issue right now, but it could be an issue down the road. If you have a couple $1 million saved up in a 401k or any other investment accounts, as that continues to grow, it's going to be subject to estate taxes down the road. And that's probably not going to be going down. It's probably only going to be going up, those taxes. So what Kevin is saying is you can start to gift those assets away now, because it's going to go back down to that $5 million level per individual. So if you have room left, it's better to gift that now in the event that it does drop back down. So I think that if you fall in that category, you need to start planning sooner than later before this expires. I think that's the biggest time sensitive tax issue I see coming up in the next 2 years.
Yeah, I think that's the biggest hanging fruit out there is to go get that one and make sure you complete those gifts now. And you can still have control of those gifts if you plan it in a very thoughtful way. You're not just giving away the money directly. And so you can give it to a trust and then maybe they inherit it a little bit later. But it's got to be a completed gift to your estate. And that way you get that. I mean, it's also, Tom, who's in charge at the time of these expirations is probably going to have a big impact on which parts of this get extended and which parts of these just expire. So depending on who's in charge of Congress, you could see certain tax brackets get hit a lot harder than others. You could see certain credits get increased or decreased. So it's a moving target for sure. But based on today's rules, I think number one is the estate tax, but just planning out your debt when it comes to mortgage deductions, and then planning out your itemized deductions. So if you're going to make a big charitable gift, doesn't make sense to do it in 24, 25, or wait until 26 when tax rates are higher so you maximize deduction now. So this is something Tom can help you with and the other advisors at Global Wealth.
Yep. Nope. I agree. So we'll touch more on some different tax strategies as we get closer. But I think that's a good start. And for those of you that want more information or have more questions, just you can shoot us an email at info@gwadvisors.net, because there's a lot in the proposal and there's a lot that's going to possibly expire within the next 2 years. So we want to make sure we're preparing now for that, so we're not caught off guard when that does happen.